On Tuesday, May 13th, we saw the latest CPI report, which showed inflation at 2.3% year over year, which was below expectations. Now, in response to the data, 10-year Treasury yields initially fell. Now, CPI data was closely watched as markets wrestle with the potential inflationary impact of tariffs. Now, higher inflation erodes bond returns, making them less attractive, while lower inflation enhances their appeal, pushing yields lower. However, the yield decline was brief, with 10-year yields quickly returning to the pre-CPI levels and near multi-month highs around 4.5%. This reflects the complex dynamics of evolving trade policy. Tariffs could drive inflation, prompting investors to pull back from bonds. Conversely, significant trade disruptions could cause global economic stress, which could steer capital toward the safety of treasuries. Now, the bond market remains caught between these two tensions. Now, the lower CPI reading increases the likelihood of a Federal Reserve rate cut. The CME FedWatch tool currently indicates 2 to 3 25 basis points reduction by year end. Now, on May 15th, the PPI report and retail sales data will provide further insight into inflation and consumer strength, potentially reshaping market expectations. Now, if a trader believes that yields could head lower from here, they could sell the May micro 10-year Treasury yield futures contract at 4.46 and target a move back to the April lows of 4.05. Now, a stop for this trade could be placed above at 4.65. This trade can make $410 if the target is reached and risks $190 if you're stopped out of your level. Now, if a trader believes that yields could head higher from here, they could buy the May micro 10-year Treasury yield futures contract at 4.46 and target a move back to the January highs of 4.78. Now, a stop for this trade could be placed below at 4.19. This trade can make $320 if the target is reached and risks $270 if you're stopped out of your level.